Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. I'm Ira Epstein, and I want to talk to you about one of the key indicators that I use on charts. It's a filter indicator, but it can also be an indicator that can offer potential support or resistance. Another way of saying if one is short and it's support, potential profit area, or if one is long and you're talking resistance, another potential, profit area. It could be. This is a daily bar chart of the S&P 500 index. Let's take the name off it. We don't care what it is. It's any chart of anything. Because it's a daily chart, I want to use a daily moving average. If this were a weekly chart, I'd be using a weekly moving average. What I'm looking for, averages of closes as well, and I'm using simple moving averages when I teach the course, which is raw math. If I go bowling 3 games, I add up the 3 scores, divide by 3, and that's my average. Well, on an 18-day, you take the current price, the last 17 closes, add them up, and then plot them out. Here's the 18-day moving average of closes as of the time that I'm actually doing this recording for you. My theory is this. The 18-day average of closes is one of the most important averages in futures. At least that's what I teach in the Ira Epstein charting course. And when the market is under that number, I'm looking for potential sell signals. When it's over it, I'm looking for potential buys. The word potential means I'm going to other indicators, but the filter is saying don't look to be short above that number and don't look to buy under it. I have found that over the years that saved me good stead. Instead of trying to pick bottoms in the markets when you're under that average, I'd rather look at rallies as potential sells, and when prices are over it, I'm looking for potential buys. At times it can be right against that average as well. The situation warrants how you work with it. There's crossovers of moving averages and other moving averages to use. One of them that I use is the 45-day. A lot of people use a 50-day. If you watch the different financial TV shows, what do you hear? You hear a 50-day moving average, a 100-day moving average, a 200-day. Remember, stocks by their own nature do what? They trade literally forever. A cash S&P market can trade forever until the index goes away. However, and there is a big however, a futures contract by its own definition has a limited time span. So a December contract for the S&P will expire by the end of December, and that's what I want you to remember. So use slightly different theory when applying it, but I don't know that you have to change the numbers that dramatically. That's what I've discovered, at least the way that I teach. So right now we've got where the two averages are coming together. If the 18-day, the red line gets under the blue in this case, it'd be a crossover. We'll come to that in a minute. And that's right here. Do you see where I've circled this for you? Notice how the 18-day got over the blue line. That's called a crossover. And on the pullback, the market confirmed it by trying to hold against the 18-day average until it got back under it here. Closing under that average would neutralize an uptrend. Got that? I think that's important. Could it start a downtrend? Well, it's a filter of other signals. So I don't think the 18-day average could do that. I think the 18-day average, the way that I teach trading, is a little different. What else can an average do? Well, I'm putting on this chart the 100-day moving average of closes. And I want to show you what happens when I blow it up. When prices, just the way that we saw the crossover here, are over an 18-day average, if another one of the key averages is above the market, it could offer potential support, or resistance. I'm sorry to say support. Resistance. And that's what happened here, and the market can go on and on. When the 18-day is under the 45 and the 45 is under the 100, you'd have what's called a bearish setup in moving averages as well. And you can flip that around if you get the short term over the medium term and the medium over the longer term. The key that I want to point out here is that this little synopsis is not meant to do any more other than get you somewhat familiar with the terminology that I'm going to use in my videos. But where you really learn about this is in my Ira Epstein charting course. And that is where I cover moving averages and how they filter swing lines, how swing lines determine what I consider to be trend and risk, how to measure potential support and resistance zone with Bollinger Bands, window envelopes, and to measure momentum with slow stochastic readings. In other words, there's a lot more to this than just moving averages, but I want you to be able to understand some of the theory of them. Hope you've enjoyed the short tutorial. I'm Ira Epstein.